Alright guys, so in this video I will be showing you how to do top-down analysis. So what is top-down analysis? Basically, top-down analysis is scaling through time frames to build your trade idea, right? So depending on the highest time frame that you want to use, in my case that being the weekly, you want to move throughout these time frames and build your argument for your trade, right? So let's see an example of this. I will show you guys a trade example and show you how I go about technical analysis, right? So I will use the bar replay function to just show. Okay, let me take this down. Yeah. So let's go to the previous week. We see that on the weekly time frame, or on the weekly time frame now, each of these candles represents 1 week of price movement, right? So on this previous week, we can see that we swept liquidity above these highs. We took out these highs and we did not close the body of the candle above these highs. So it means we're likely going to get lower prices because we swept liquidity. However, there is a possibility that obviously price could still just push higher to take out these highs, but the likelihood is that price will push lower to take out this level. And we also need to consider that below here we have a volume imbalance. So these are good liquidity pools that price is likely to return to before moving higher or before moving lower. So yeah, we have a volume imbalance. For those of you who don't know what a volume imbalance is, I think the simplest way I can explain this from my own knowledge is basically it's just a gap within the candles, you know. Obviously there's like a Google definition, but I'm trying to tell you what's practical and how you're going to look at it on the chart. So you see this is your volume imbalance right here. You can see that there's a gap within the charts. So that's basically what it means. So you see that when price leaves volume imbalances, there's a high likelihood that price will trade downwards or trade towards it to take it out before moving in the opposite direction, or moving in or continuing in the same direction, whichever way that price wants to continue moving. So that's the weekly time frame done, and we are expecting the weekly expansion. The weekly candle should likely expand lower to take out this volume imbalance and to take out these highs, since it's already swept buy side liquidity. Then now we move to the daily time frame. And we realize that on a daily time frame, there are relative equal highs here on the daily time frame. Relative equal highs. We sweep those relative equal highs, and we can see the volume imbalance clearly on the daily time frame. So we're obviously expecting lower prices. That doesn't mean that we can't find good buy setups or whatever, but we already have that understanding of what the overall direction is going to be on the higher time frames, right? Now we move to the 4-hour time frame, and I hope that you guys are getting a better understanding of what time frames are and how they look. So you can see the 4-hour time frame, and you can see the daily time frame. It basically looks like the same thing, but in this case each candle represents a day of price action, and in this case each individual candle represents 4 hours of price action. So now we're on the 4-hour time frame, right? We're on the 4-hour time frame, and you can see obviously the relative equal highs are quite obvious. We tap into them, you know, and let me just mark out the 4-hour dealing range. So on the 4-hour, this is basically our range. We have this high, and we could mark it down to this low. So we know that there is a strong likelihood, since we've already swept liquidity on the 4-hour, we've already swept buy side liquidity on the 4-hour time frame, we could likely push price downwards to take out this low. Or even if we don't take out that low, there's a possibility that we could likely take out this unfilled fair value gap on the 4-hour. So now we can move to the 1-hour time frame, and this is what price looks like on the 1-hour time frame, right? On the 1-hour time frame, pretty much the same thing. We even have this 1-hour internal 1-hour liquidity sweep, where price sweeps the stop losses of early sellers. So there's people who saw this selling move here, probably got in sells around here, price moves higher to take out their stop losses. So that's another 1 minute internal liquidity sweep. Let me just write liquidity on that. Alright, we have that 1 minute internal liquidity sweep. Move to the 30-minute time frame now. Now on the 30-minute time frame, basically the same thing, you know, a little bit of consolidation here, a little bit of chop, but we're obviously still looking for lower prices, right? Because we've already swept buy side liquidity. So we could use this level here as our draw on liquidity. Why is this candle like this? Yeah, we could use this level here as our draw on liquidity. This low right here, let me just write it down. DOL. Draw on liquidity. We'll use this as our draw on liquidity as a level that we would like to trade to and put our take profit at, or our take profit slightly above it, or our take profit slightly below it. Move to the 15-minute time frame now. And now here's where we want to pay attention to time. So now it's showing 4:45 on Friday, right? So we were looking to start trading on Monday, right? Obviously on Monday, so I'll mark out Monday at 2 a.m. on Monday. London session, that's London session open, and then New York session open at 8 a.m. So now I just want to play this out because I'm using the bar replay function, obviously. Play this out. Yeah. Okay, on the 50-minute, this is what price looks like. So price is pretty close to our draw liquidity, and we can see that we are clearly respecting bearish PD arrays, and we are respecting bearish market structure. We've tapped into this bearish 15-minute FVG, respected it. We've tapped into this other bearish 15-minute FVG, and we've respected it as well. So we're clearly kind of trending downwards, and we're moving downwards. We're seeking out lower prices. All right. Now, there is also a possibility that we could miss out on this setup and price could literally just move straight down. You know, price could literally just drop straight down. We could miss out on the setup. We don't make any money for the day, or you know, we don't catch a trade for the day, or whatever. Yeah. But we want to see what price will do when the 2 a.m. 4-hour candle opens. There's 2 4-hour candles that I want us to focus on when we're trading. We'll focus on the 2 a.m. 4-hour candle and the 10 a.m. 4-hour candle. This is all Eastern Standard Time, New York time, right? So let's see how this candle opens. Okay, it opens really bearish. It drops really close to our draw on liquidity, right? Now I can mark out the 4-hour opening price. Let me put this properly out. Yeah, I was thinking that this. Just wanted to make sure that it was, you know. Okay, so yeah, I will mark out the 4-hour opening price, and to mark out the 4-hour opening price, you would see that here is the level that the 4-hour candle opens, right? So this is the 4-hour opening price. We'll mark it out like this, and put 4-hour open right here. So this is the 4-hour opening price. Let's bring this closer. Yeah, this is the 4-hour opening price. So we're looking for price to perhaps trade above this, or if price has already traded above this, let me scale down to the 5-minute time frame or to the 1-minute time frame. You scale down to the 1-minute time frame, we see that yeah, price has already traded above this 4-hour opening price. So there is the possibility that price might not trade above it again, just so you know. So we could mark out this 5-minute gap. There's a possibility that price could take this 5-minute gap, but if we're bearish, I wouldn't like to see price take out this 5-minute gap, because this is already basically like an internal liquidity sweep, a lower time frame liquidity sweep. We also have this gap, so yeah, definitely we could basically scrap this gap. This gap, if this gap gets tapped into, I would like to say we're not really bearish anymore, and we might be wrong on our trade idea. So because we've already tapped into this gap, and this was like the first candle of the 4-hour opening price. Sorry, the 4-hour open. Then we also have this 5-minute gap right here. So for me, I could take my trade. I could use a market order, or I could use a limit order, and I could take my trade here at this 5-minute FVG and put my stop loss above the high that created the 5-minute FVG, and I can put my take profit here for a 1 to 2. Let's see if we get tagged in and if we get this trade. Okay, we get tagged in. Okay, so yeah, it was a winning trade, and I hope you guys have an understanding of how you do top-down analysis and how you basically build your argument for your trade. So you see that we started from the weekly time frame, we scaled down to the daily, we scaled down to the 4 hour, we scaled down to the 1 hour, we moved down to the 30-minute time frame, and we built up our trading idea. We also use draw on liquidity. So instead of using daily buyers, we just want to know what the weekly expansion is likely to do, and then we want to use draws on liquidity. So if we know that buy side liquidity has been taken out, the next liquidity pools that price could aim for is the sell side. That's just an easier way of looking at it, because that is how the market moves, you know, from liquidity, seeking out internal range liquidity to external range liquidity to internal range liquidity to external range liquidity. The market just seeks out liquidity. So yeah, thank you guys for watching this video, and I will see you guys in the next one. I feel like I've really done well to cover a lot of stuff these past few days. If there's any questions, please leave comments to ask me questions. I will continue to make more videos to explain anything that anyone doesn't understand, and I will continue to teach myself, to make myself better, to make the knowledge that I'm providing to you guys better. And yeah, thank you guys for watching.